Cable is pressing into a massive resistance zone, but there's a hidden divergence on the weekly chart that has me seriously concerned. The RSI is making lower highs while price is making higher highs. I've seen this set up 4 times in the last decade, and 3 times it led to a sharp reversal. I'm breaking down both scenarios with exact entries, stops, and targets. The UK jobs data and US CPI are about to trigger the next big move. Let me show you something on the weekly chart that most retail traders are completely missing right now. I've seen this hidden divergence pattern 4 times in the last decade, and 3 times it led to a sharp reversal that caught the majority of the market offside. 1 time it didn't, and that was the March 2023 breakout that ran for 400 pips before anyone realized what was happening. What I'm talking about is the divergence forming on the weekly RSI against the price action on pound sterling to US dollar. Price is making higher highs, pushing into the 1.3493 level after a powerful rally, but the RSI is making lower highs. This is what we call a hidden bearish divergence, and it typically signals that the buying momentum is waning even as price continues to push higher. Now, I'm not saying this is a guaranteed reversal signal. Divergences are notoriously tricky, but when you combine this with the fact that cable is pressing directly into a major supply zone at 1.3510, the risk-reward for chasing longs becomes highly questionable. Let me break down exactly what I'm seeing and how I'm positioning for the week ahead. My verdict for the week is cautious bullish with a very specific condition. I am looking to buy dips, not breakouts, until we see a confirmed close above 1.3510. My invalidation level for the bullish bias is a daily close below 1.3390, which would break the near-term bullish market structure and suggest that the divergence is playing out with a sharp reversal. I'm calling this a pivotal week with the potential for significant two-way volatility. The Bank of England's hold at 3.75% provides a yield floor for sterling, but the US data calendar is packed with high-impact releases that could overwhelm the domestic UK story. The weekly trend is bullish with strong structural defense of the recent trading range bounds, but the daily trend is neutral bullish, advancing into the upper boundary of its short-term trading corridor. This suggests we are at a decision point rather than a clear trend continuation. I want to start with the weekly chart because that's where the big picture story is being written right now. The monthly trend is bullish, with primary structure showing steady accumulation and what I believe is a potential long-term diamond pattern playing out. This is a pattern that takes months to develop, and when it resolves, the move is typically explosive. The weekly trend is bullish, with strong structural defense of the recent trading range bounds. We've been consolidating between roughly 1.3200 and 1.3510 for the better part of 3 months, and this week we're testing the upper boundary of that range. Now, here's where it gets interesting from a technical perspective. The weekly RSI is showing a clear hidden bearish divergence. Price made a high of 1.3510 in late July, pulled back to 1.3404, and then rallied back to 1.3493. The second high is slightly lower than the first high, but the RSI reading on the second high is significantly lower than the RSI reading on the first high. This is a classic momentum divergence that suggests the buying pressure is exhausted. In my experience, these weekly divergences are rare and typically precede at least a significant pullback if not a full trend reversal. Let me share a personal observation from 20 years of trading. What stands out to me is not just the divergence itself, but the fact that we are seeing it at a multi-month resistance zone. I've learned the hard way that divergences at key structural levels carry more weight than divergences in the middle of a range. This level reminds me of the September 2023 situation where we had a similar weekly divergence at the 1.2700 resistance, and the market dropped 300 pips over the next 2 weeks. The only reason I'm not aggressively shorting here is the fundamental backdrop, which is vastly different from 2023. Moving to the daily chart, the trend is neutral bullish, advancing into the upper boundary of its short-term trading corridor. We are currently trading at 1.3493, which is above all the major moving averages. The 5-day MA is at 1.3465, the 10-day at 1.3450, the 20-day at 1.3435, the 50-day at 1.3390, the 100-day at 1.3420, and the 200-day at 1.3315. This is a fully aligned bullish moving average structure, which supports the case for continued upside. But the RSI on the daily chart sits at 59.80, which is bullish but not overbought, and the MACD is showing a bullish histogram crossover confirmed above the neutral baseline. The ATR of 0.0076 indicates a localized compression in the daily average true range ahead of the CPI release, which typically precedes a volatility expansion. The 4-hour chart shows bullish continuation with positive market structure following consecutive daily gains. The ADX at 21.40 is a lower but stabilizing reading, flashing a neutral to developing directional trend. This tells me that the trend is not strongly established yet, which aligns with my cautious bullish stance. The CCI at 95.10 is leaning heavily into positive territorial bands, favoring structural buyers. The 1-hour chart shows neutral consolidation, with price moving sideways in early Asian trading hours after late-week dollar selling. This is typical holiday-thin liquidity, and I expect the Asian session to be range-bound until the European Open. Now let me shift to the fundamental story because this is the engine that's going to drive the next major move. Cable continues to track broad greenback weakness rather than domestic UK impulses. This is a critical point to understand. The recent rally in pound sterling to US dollar is almost entirely a dollar story rather than a sterling story. The extreme data soft spots in the US, notably an anemic private payrolls print of 44,000 against a 75,000 consensus forecast, have fueled global institutional dollar liquidation. When the US employment data collapses like this, hedge funds and asset managers are forced to unwind long dollar positions, and cable is one of the primary beneficiaries. But sterling remains fundamentally anchored because the Bank of England opted to hold rates steady at 3.75% during its last split vote meeting. The BOE is one of the few major central banks that is still holding firm on rates, while the Fed is increasingly looking at rate cuts. This policy divergence is a structural bullish factor for cable. The yield spread between UK gilts and US Treasuries has widened in favour of the UK, and that's attracting yield-seeking flows into sterling. Now, let me walk you through the high-impact calendar events that are going to define this week's trading. On August 11th, we have the UK Average Earnings Index and unemployment rate release. This is crucial for Bank of England wage growth tracking. If wages come in stronger than expected, it will reinforce the BOE's hawkish stance and provide a boost to sterling. If wages disappoint, we could see some pressure on cable. But the real big event is on August 12th, the US Core Consumer Price Index. This is the critical data point that controls systematic DXY portfolio trends. The market is expecting a continued moderation in core inflation, but the risk is that CPI comes in hotter than expected, which would spike the dollar and send cable sharply lower. I've seen this play out so many times where a CPI surprise catches the market completely off guard. The invalidation for my bullish bias is a strong CPI print that forces the dollar higher. On August 13th, we have US core retail sales and weekly initial jobless claims. Retail sales measure underlying US consumer strength, and jobless claims monitor building cracks in the US labor market. Both of these releases could move the pair significantly, especially if they reinforce the narrative of a weakening US economy. Now let me get into the specific trade setups that I'm looking at for the upcoming week. I've got 2 scalp setups for the 24-hour time frame and 1 swing setup for the 5-day period. Scalp setup 1. Bearish supply rejection SCLP. The first scalp setup is a bearish rejection play off the 1.3510 supply zone. If price spikes into the 1.3510 to 1.3530 supply zone during the London morning session but structural buyers fail to sustain the volume profile, I'm looking to initiate short positions. The trigger here is a failure to break above 1.3510 with momentum, or a rejection candle pattern on the 5-minute chart. My entry would be around 1.3510 to 1.3520, and I'm targeting a swift scale-out at 1.3465. My protective stop-loss is pinned at 1.3545. This gives me a risk-reward ratio of approximately 1.6 to 1. The invalidation for this setup is a 4-hour close above 1.3530. Scalp setup 2. Bullish pivot bounce SCLP. The second scalp setup is a bullish bounce off the weekly pivot. If an early dollar recovery flushes cable down to the 1.3450 to 1.3455 support node, which is confluent with the weekly pivot point, I'm waiting for a 5-minute candlestick tail rejection to develop. My entry would be around 1.3450 to 1.3455, and I'm targeting a return bounce to 1.3490. My defensive stop is placed at 1.3430. This gives me a risk-reward ratio of approximately 2 to 1. The invalidation for this setup is a 1-hour close below 1.3430. Before I share the swing setup, I want to pause and ask you something. Are you seeing the same hidden divergence on the weekly RSI that I'm seeing? Or do you think this is a case of overanalyzing a minor momentum shift? Drop your thoughts in the comments because I genuinely want to know what the community is seeing. I've been known to be wrong on divergences before, and the best trades often come from collective wisdom. Swing setup. 5-day bullish pullback peeler. Now let me break down the swing setup that I'm looking at for the next 5 trading days. My market bias is tactical bullish on value defended. The broader daily and weekly trend matrices favor a long position configuration, provided the primary structural support boundaries survive the upcoming macro calendar. My primary accumulation zone is 1.3404 to 1.3450. This structural zone aligns with the 10-day and 20-day moving averages, providing significant technical support. I'm looking to scale into multi-day long positions if early week market posturing triggers a liquidity flush ahead of the US CPI print. The idea is to buy fear ahead of a potentially dovish CPI reading. If the market prices in a significant pullback on the back of US data anxiety, I want to be a buyer in this zone. My invalidation point is a decisive daily close below 1.3390. This breaks near-term market structure, signaling a potential trend breakdown and requiring immediate capital conservation. If we close below the 50-day moving average, the bullish thesis is invalidated, and I would exit all long positions. My profit targets are structured around the key resistance levels. Target 1 is 1.3560. Which is the prior structural swing peak and horizontal volume inflection point. This is the logical first area to take partial profits. Target 2 is 1.3600, which is the major psychological milestone and midterm technical target zone. If we break through 1.3510, the path to 1.3600 becomes relatively clear, as there's very little historical resistance in between. I want to emphasize a personal insight here. The only time I've seen a hidden weekly divergence fail to produce at least a 100 pip retracement was when it was accompanied by a fundamental shift that overwhelmed the technical signal. In 2023, we had a similar divergence on pound sterling to US dollar that was overridden by a massive shift in UK rate expectations. That's why I'm watching the UK jobs data and US CPI so closely. The divergence is a warning signal, but the data will determine whether it's a speed bump or a trend change. Let me take 30 seconds to emphasize the risk management aspect of these setups. I've been trading for 20 years, and I can tell you with absolute certainty that the traders who survive and thrive in this business are the ones who treat risk management as their primary edge. The setups I've given you are only as good as your ability to execute them with discipline. Never risk more than 1 to 2% of your account on any single trade idea. And never add to a losing position. Here's a personal risk anecdote that I think about often. Back in 2020, I had a swing long position on pound sterling to US dollar that was based on a similar technical setup to what I'm showing you today. The trade moved against me by about 80 pips in the first 48 hours, and I was tempted to add to the position to average down. But I held my discipline and kept my stop at the invalidation level. The trade eventually reversed and hit my profit target. But the lesson was clear. My discipline on that initial stop preservation allowed me to stay in the game. If I had violated my rules and added to a losing position, the drawdown would have been psychologically and financially damaging. Respect your stops, respect your position sizing, and you'll be in this game for the long haul. So let me summarize the key takeaways for the week. The hidden bearish divergence on the weekly chart is a warning signal that should not be ignored. But the fundamental backdrop favors dollar weakness rather than sterling strength. The line in the sand is 1.3510. Above it, I'm looking at a clear path toward 1.3560 and then 1.3600. Below it, and we could see a pullback toward the weekly pivot at 1.3450, and potentially even deeper toward 1.3404. I'm leaning cautiously bullish on pullbacks, but I'm not chasing breakouts until we see confirmation. I want to remind you that I'll be back on Friday with a live market wrap covering the US CPI and retail sales reaction, and on Sunday with the complete week ahead forecast. So make sure you're subscribed with notifications on so you don't miss those videos. In the meantime, if you haven't watched my previous video on the Bank of England's policy outlook and its impact on the pound, I'll link it in the description. The piece I did on the correlation between UK rates and cable could be the most valuable video you watch all month. I also want to hear from you in the comments about your view on this hidden divergence. Are you seeing the same pattern, or do you think I'm overthinking it? I read every single comment, and I'll be engaging throughout the week as the market develops. Alright, that's all for now. This is Eric, Trade Meridian Decoded Channel signing off. Stay disciplined, stay focused, and I'll see you on the charts.